Hey, it's Jim, and this is FRM Part II, topic on operational risk and resilience, and the chapter on case study, investor protection and compliance risks in investment activities. The very first sentence of this chapter indicates that investor protection refers mostly to making certain that investors are informed. And that's probably a really good idea to remember for exam questions. And I can't help but think to go back to some of our history lessons to, of course, Eugene Fama in 1970, who taught us about informational efficiency. But perhaps even more important, back to 1958 and Modigliani and Miller in their awesome capital structure irrelevance proposition, in which they assumed that all investors had the same information set. Now, clearly, that is not the case. And because investors don't have the same set of information, then we need this investor protection. And you'll see that as you look through the two learning objectives. And so these are very, very similar to what we've been doing inside of these series of chapters. Remember that first learning objective for, we had cybersecurity, we had third-party risks, we had anti-money laundering, we had these different types of chapters. And the first learning objective always seems to be, all right, what are we focusing on in here? And inside of this chapter, important regulations. And we'll go ahead and talk about some regulations and laws in the United States and the UK. That'll be our first learning objective. And then the second one is, let's go ahead and figure out what are some of the lessons learned from particular case studies. So let's go ahead and get started with that first one. And I want you to just pretend that you don't see that very first teardrop point. I'm going to come back and emphasize that here in just a few seconds. So we have the European Union, we have US Congress here, comprehensive investor protection laws. And this is mostly because that Congress either anticipates, meaning they're proactive, or they pass these laws in reaction to some financial crisis that has occurred. And so the important thing to remember here in terms of an exam question is that these regulatory and legal bodies in these two different jurisdictions are doing their best to make certain that investors are protected. Go down to the bottom there. It tells us about misrepresentation and fraud, cross-jurisdictional cooperation. So we have people here, and then an ocean in the middle, and we're trying to figure out what is best for these global markets. Now, we talked at length in a recent recording about this KYC, Know Your Customer Requirements, and anti-money laundering. And so these relatively recent laws and regulations kind of tie in anti-money laundering with investor protection laws. So let's go back up to that very first teardrop point. Look what we have bolded. Investors are fully informed about their investments. So that's the overriding theme of these rules and regulations, and probably going to be the overriding theme in the exam questions, at least if I were crafting these exam questions. All right, so there are a couple of directives. One of these goes back to 2004. Markets in financial instruments. And this first one in 2004 pretty much attached these regulatory requirements for financial market activities. And, it was pretty broad. And if you go back and take a look at it, which the chapter doesn't really go into much detail, but it's very broad, and there were gaps and weaknesses in it as evidenced by the 2008 financial crisis. That's why we needed the second directive a couple of years after the 2008 financial crisis. But look at that second to last arrow point. Regulatory reporting is mandated, and transparency to prevent market abuse was super emphasized. I mean, it's not like transparency is just a new word that we learned back in 2008, but of course the importance of it. So that's the response. What was I saying earlier? Here, just let me go back here quickly. So fully informed about their investments. Now, you and I, let's just suppose that we don't have access to Bloomberg, and we don't have access to Morningstar, and we don't read the Wall Street Journal. How are we going to become fully informed about our investments? And the answer is, well, we would have to do lots and lots of really, really hard work And even then, we might not be able to come up with the full information. That's why that word transparency. And if you go look at these MiFID rules and regulations, the word transparency is in there all the time. So what are we focusing on? We're focusing on fully informed, and we're focusing on transparency. So the fully informed is the responsibility of the investors. The transparency is the responsibility and now compliance requirements from these regulatory bodies by not only the issuing entities like a company or a government, but also the intermediary, of course, which we are in the financial services industry. So there we go. June of 2014, the EU adopted a revised directive. So this is Directive 2. And this also had a regulation in there. So that's the MiFIR. And this was kind of a separate thing. So regulations and direction are two separate parts of the same European Commission adoption. So look at that second arrow point. You're not surprised to see this, right? Public disclosure requirements. That's from the issuing entity, and then transaction data reporting. That's from the financial institutions in which we are responsible for saying, hey, you know what? This is what's going on. Make sure everybody knows what's going on. Now, the regulation addresses incentive in structures and investment activities. So look at the little illustration we have down there at the bottom. So these are key aspects, and these are probably really good exam questions here. Remuneration. This is the idea about how the financial analysts and wealth managers can get paid. And what we're trying to do there with this directive is to say something like, you know what, if you guys want to hire me, if I'm a wealth manager and you say, all right, Jim, here's all of my money. I want you to do whatever you want with it to make me lots and lots of capital gains and dividends and coupon payments. And I go out and I take this much risk. And you're really only willing and able to take this much risk. But I take lots more risk because a part of my incentive structure was to say something like, look, if your return objective is 10% and I earn 30%, then let's do 30 minus 10, that's 20. So I outperformed, let's say, by 20%. Well, maybe we'll take that 20% and multiply it by some number. So that gives me an incentive to take more risk than what you're willing or able to take. And that's probably not conducive and probably not going to fit into your risk and return objectives. And so these compensation packages now should be more clear, less designed to motivate me to maximize my own wealth, but more inclined to motivate me into adhering to the terms of the policy statement. Of course, this applies to me as an individual. It applies to me if I'm some type of an institutional investor. What that does then is it leads into all of these other things, these other blocks on the right-hand side. It removes the conflicts of interest. It defines the scope, what it does. And look at the middle one there, trade execution. One of the things that's part of this regulation is that we want to get the best execution. We want to get the best trade. In other words, I don't just go to my best friend over here and say, here's a bunch of trades. You just do whatever you want with it and let me know. That's not the way it should work. I need to go and say, okay, here's my best friend over here, but I also have these other 7 best friends. And sometimes each of those are going to be my best friend, and the other ones will just be my casual friend. So we need best execution. Dealing with eligible counterparties, that goes back to our conversation on third-party risk, managing in that framework that we talked about before. Communication with clients, boy, that's an emphasized point that we've made previously, and product governance. That makes perfect sense. All right, so that was all in Europe. Let's go ahead to here in the United States, Dodd-Frank Wall Street Reform and Consumer Protection Act. It's just pretty much known after its 2 gentlemen who authored this, Dodd-Frank. This, of course, was the Congress's response to the 2008 financial crisis. So go ahead and read that first arrow point. That's probably a good exam question. The question would sound like, what was the motivation for Dodd-Frank? Promoting financial stability, safeguarding consumers. So as you read those, look there: protect, 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 restrict, established, enhance. So what does this sound an awful lot like? It sounds an awful lot like transparency and fully informed. Now, I do like that very first one: to protect U.S. taxpayers by ending bailouts. Let me go ahead and take off my FRM hat and say something like, okay, we still seem to be having lots and lots of bailouts there. All right, so let me put my FRM hat back on. Abusive financial services practices. So this is going to be a really important lesson that we learn in the latter part of this recording. Bottom left there, we've talked about monitoring before, proprietary trading restrictions, and there's a huge part of, and you know what, I didn't mention this back here, there's a huge part in trade execution here and scope of investment advice with trading on derivative securities. There's a movement, and this is part in Europe and here part of Dodd-Frank, a movement to require, to motivate, to promote the trading of derivative securities on some type of an exchange that is broad and deep. Today I could probably open up Jim's derivative market and I could say, hey, come on over here and I'll do my best to find a buyer and a seller. Well, didn't we just have this in early 2023 where we have people arrested for trading on Bitcoin exchanges and having Bitcoin exchange lack of transparency? All right, so monitoring there, over-the-counter derivatives trading. Key elements of Dodd-Frank. The Volcker Rule. So this was named after Paul Volcker. So restricting speculative and proprietary trading in bank activities. So just a quick history lesson. You go all the way back to 1933, I think it was 1933, where we had this big old wall that separated commercial banking from investment banking. And then in 1980, that wall was kind of torn down. And so, kind of muddled the legal and ethical and moral activities of financial institutions so that they could do all sorts of fun things. But now what this Dodd-Frank does, banks are not allowed to invest in hedge funds and private equity funds. That's probably a really good exam question. It created this Consumer Financial Protection Bureau. So look at these: mortgages, student loans, credit cards, and maybe some other consumer rights. So what that does is that enables us, when we go into a financial institution as a consumer, that we know that we have this federal agency that is protecting us so that we don't want to be denied a student loan or a mortgage loan or a credit card because of some other reason that's out there. And then once again, here's OTC derivatives oversight. So we want to push these things so that we can increase transparency. Boy, we're not surprised to see that. Then there's a section on compliance risk management, which means that of course, we have these new rules and laws and regulations that we need to comply with. So we're going to have to, of course, pay for those things. So compliance risk management initially should be focused on, all right, how much is this going to cost us? And then what are we going to get out of it? Of course, marginal cost, marginal benefit. And so this, in the broader scheme of operational risk management, we know what these marginal costs are going to be. Well, let's go ahead and make certain that we get marginal benefits that are going to exceed those marginal costs. So look at the second teardrop point: poor employee engagement, dissatisfaction, stress, weak ethics culture. Add to that a weak risk culture, insufficient resources. So throw those things in there. If we are focused on compliance risk management, I'm going to go ahead and say this, I'm going to put a word there: efficient compliance risk management, then our marginal revenues are going to exceed those marginal costs. If you read the Wall Street Journal regularly, which I recommend in almost every recording, you'll read about banks, especially medium or smaller banks, who complain about these costs, and well, they should. However, it's their responsibility as good stewards of the shareholders' capital and as good stewards of the economy to make certain that whatever those costs are, they're recovered by improvements in efficiency. And we've seen these lessons to be learned in the last 6 or 8 different chapters that we've covered. All right, compliance risk management. Let's go back to asymmetric information. This is what I was saying earlier. Modigliani and Miller just assumed that everybody had the same information. We know that's not true. We know that there are conflicts of interest. We know that there are economic conditions that are going to increase operational risks in that broad spectrum. And so this risk management framework emphasizes effective supervision and employee training, and then monitoring. Didn't we go through that with anti-money laundering? We went through that with cybersecurity. So these are similar concepts that we've focused on in previous recordings. Now, this is always my favorite part of these readings. This chapter really doesn't give us too many details about, and let's go ahead and do a lesson learned here. So misrepresenting auction rate securities to investors. Now this happened, maybe over a decade ago. UBS, they were fined a whole bunch of money. What they had to do is they actually had to repurchase these securities from the investors that they sold them to. Now, auction rate securities, these things don't get too much attention in the financial press. In fact, I hardly ever read about these things in the Wall Street Journal. Maybe I'm just missing those articles with regularity. But let me go ahead and tell you about how cool these things are. So an auction rate security, these are issued that are backed, maybe by a municipality, maybe a corporation, maybe mortgage-backed securities, maybe credit cards. They could be almost anything, right? But they're typically, some of these are preferred stock, but I don't ever even want to talk about preferred stock because it's relatively dull. But most of these are long-term bonds, 20 or 30 years. But what happens is, all right, auction rate security, what happens is that instead of having a fixed coupon rate, like a fixed bond, instead of having a floating coupon rate that might be tied to, like in the old days, LIBOR, and the new days, SOFR, or any of those other overnight interest rates. But these auction rate securities then, over time, they'll auction off the coupon payments so that those coupon payments are reflective of current interest rates. And these are really cool things. Most of these are done through what's known as a Dutch auction. But what happened in 2008 is that the auction was frozen because who knows what was happening in 2008. So financial institutions just called a timeout. They said, you know what, we don't really know what's going on and we don't trust what's going on and we don't want to take these huge losses. So they just froze them. So what does that say? Misrepresenting these securities as safe cash equivalents. Well, when it's a cash equivalent, that means that you have access to the capital. But when they're frozen, that means that you don't have access to the capital. And so this was an egregious violation of misrepresentation. And so they had billions of dollars in repurchasing those securities. And then they had to pay just a relatively small fine, $150 million. So remember that for the exam, even though the chapter doesn't really tell you all about this auction rate security, but it sounds to me like this is a great lesson to be learned. Misrepresenting a security when selling it to the investing public as being safer than what it actually is. So go back to what I was saying earlier. Fully formed investors and transparency. JP Morgan, just a few years ago, was spoofing, placing and canceling large orders. Do you remember that example when I was telling you about anti-money laundering and terrorism financing? And I made up the crazy example of me showing up on the floor of the New York Stock Exchange with a wheelbarrow full of money. What did I say? $100 million in my wheelbarrow. And so I get in line, and the specialist trading unit, what do they call these things now? Just regular old market makers, sees me in line and raises the price. And so I get up and I get to line. So the bid and the ask price has to be raised. So right before I get up in line, I have all these other people, my friends in the other line, and they're trading opposite of me, taking advantage of that higher price. Maybe they're shorting the securities or whatever it is. And then as soon as I just pull my wheelbarrow out, placing and canceling large orders. I mean, that's a crazy example, but that's essentially what happens with this spoofing. And so they paid almost $1 billion for deceptive conduct and market manipulation. And then remember what I was telling you earlier about the trade execution. So Deutsche Bank, relatively recently, they just avoided finding the best price for all of their clients, failure to secure favorable trade term for customers. So execution delays and lower fill rates, rebates from routing orders, and these were barely disclosed. So this is a violation of all the kinds of stuff that we've talked about throughout this very short reading. So there we go. Learning objectives. So we know about these directives and the regulation and Dodd-Frank, and then we know about lessons learned. What are we focusing on? We're focusing on transparency and fully informed investors. So that was fun. That was short. Hey, thanks for watching and good luck studying.